This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to be looking at group audits. A bit of an accounting refresher first. So remember from your SBR, the different categories of investment that the parent can have. There might be a subsidiary where there is control, which is often where there's a situation where the parent's got more than 50% of the shares. In that case, the method of accounting, remember, is consolidation. So we add together the individual assets and liabilities, income and expenditure, and we calculate goodwill and NCI if we're not 100% parent. If you don't have control, you just have significant influence, so perhaps just one director on the board, sometimes evidenced by shareholdings between 20 and 50%. The method of accounting, equity accounting. Remember, that's like being an equity partner in an accounting firm. So equity accounting, cost plus share of profits. When you become an equity partner in an accounting firm, then you put money in, cost, and you're entitled to a share of profits. Finally, when you did SBR, you met joint ventures. So this is where two or more people have got joint control. Again, they've each got a right of veto over key decisions. Again, it's equity accounting. So we need to be able to recognise that situation. Probably the larger questions, though, would focus principally around subsidiaries. Just want to introduce some jargon. When we talk here about a subsidiary or associate or joint venture, in audit terms, it is traditionally referred to as a component. So technically, the ICA says it's an entity or business as determined by the group auditor. So typically a subsidiary, associate or joint venture. So in the exam, we tend to type the word component instead of subsidiary. At the same time, it's not the end of the world if you say subsidiary. The auditor of that subsidiary or associate then becomes the component auditor. The ICA requires that the component auditor is seen as part of the overall group audit team. ICA 600, they rewrote it because they were concerned about blame shifting. So the auditor of the parent would blame the auditor of the subsidiary. The auditor of the subsidiary would blame the auditor of the parent. And I think a lot of the thrust of the standard is to say, look, you're all in this together. Let's have a look at a typical group structure. There we are. So if you look at the names here, you can see the one that seems to appear most is the ABC auditor. So the ABC auditor does the parent, one of the components, and also the group accounts. But a different firm actually audits another subsidiary, and I've called them the XYZ auditor. Now, of course, the parent has to make sure that the parent auditor has to make sure that they get involved in the audit of each component. They can't just blame shift and say, well, that's your job, XYZ auditor. There'll be a measure of delegation, but there must be involvement. So the parent auditor, ABC, is responsible for the parent audit opinion, one of the subsidiaries' audit opinion, but also the group audit opinion. Would it be appropriate in the group audit opinion to say, well, we've audited the group, but not this particular subsidiary, that was done by XYZ and they're probably not very good? Of course not. So generally, we do not refer to the component auditor in the group audit report. Essentially, we take the responsibility. We are involved in them, they are involved in us. That's the thrust of the ISA. When you have any component auditor, and this is true for both the subsidiary, both of the subsidiaries, but especially the XYZ auditor, you have to make an assessment, don't you? Decide whether you can rely on them. You can use this checklist, which I use for this, but you could also use it for internal audit or experts or service organisations. You see all of those in the syllabus, so if you're trying to have a little reliance thing, I quite like this mnemonic, STRIP. I'm looking now at the auditor of a particular subsidiary and I'm saying, let's consider these factors. It's particularly relevant if the subsidiary is in a different country because they may well have different accounting, different auditing, different ethical and even different regulatory standards, if you like. So I look at the work that's been done. Is the work relevant to our audit objectives? In some countries, they may do a very thorough audit of the P&L for tax reasons, but they're not bothered about the balance sheet. So is the work relevant to what we need when we assess the fair presentation of the group accounts? Technical competence. Are they suitably qualified? Again, to the right standard. Resources and professionalism go together really, but I just like the mnemonic. But resources, again, have they spent enough time on the audit? That's part of quality management. To be honest, that's more useful if you're assessing an internal auditor, I suppose, but nevertheless, it's a consideration. If the other auditor is in a different country, we have to think about local ethical standards, and we'll have to challenge and say, what are the standards that you follow? Are they the same as ours? But are they truly independent of the client and of its management? Even if they're technically competent finally, they might lack professionalism and they might not have carried out audit work of the required quality. Remember quality management that we talked about in a separate lecture? Delegation, review procedures, opportunity for consultation for the staff, a partner firmly in charge of quality management. So all of those factors again, are they built into that component auditor? So if you're assessing a component auditor, scope, technical competence, resources, independence, and professionalism. Clearly, just as mummy is talking to baby and says, this is what you can do and this is what you can't do, this is what I need to know about, well, the group auditor is a bit like mummy talking to baby when they talk to the component auditor. So they have to assess materiality. Now, try and learn this slide. 2 things that must be communicated. Component performance materiality. So when at the subsidiary they're doing the audit work, you need to give them a figure and say, this is the figure that would cause us concerns. Again, so use that figure when you're planning your work. Let's just say that that figure is perhaps 5. In addition, you'd also want to know about the key errors, even though the ones that are less than 5. So therefore, again, you'll communicate a threshold, again, above which misstatements must be communicated. So if the performance materiality for the subsidiary, for the sake of the group audit, is 5, perhaps the threshold might be 1. We want to know about all the errors above 1 or half or whatever you've agreed. So, very important that we communicate again what matters size-wise. And don't forget, materiality is also relevant with things that are material by nature. Put this slide together to summarise the sorts of audit risks that you might see in a group audit question. Don't forget, group accounts are where you take the parent and the subsidiary to form the group. So I've tried to summarise here some of the things that would cause problems. In the parent's accounts, I'd be concerned about the carrying amount of the investment in the component. Remember, that's a financial asset. This would be particularly relevant if, for example, the subsidiary is loss-making. So if the subsidiary makes losses, it could be there's a need for impairment in the parent's accounts. And often, things like dividend levels are determined by the profits in the parent's accounts, not the group accounts. So that can be a very sensitive number. On a slightly duller level, but it's still important, in both the parent and the subsidiary accounts, we do have to think about related party transactions. Remember, IAS 24 says that if a parent sells to a sub, then the parent will disclose it as a related party transaction. The sub will book it as related or disclose it as a related party transaction. They might forget. I know it's only a disclosure thing, but again, it's a valuable mark for us in the exam. It doesn't happen in the group accounts, of course, because these things will then have cancelled out. If you're dealing with a foreign sub, remember that's got to be translated from the functional to the presentation currency, and we know that that's complex. In particular, when you have been studying SBR, you found again how the calculation of goodwill with a foreign sub, the calculation of exchange differences in other comprehensive income is messy, so that could easily go wrong, which makes it therefore an audit risk. Sometimes different policies, in which case the sub's policy will have to be brought in line with the parents. So that's one issue. Could have different year ends. Well, don't forget the maximum gap allowed is 3 months. And as we spoke about before, there may be different component auditors. Finally, when we come to consolidate, we get into the group accounts and we think what the risks might be there. We'll take account of the control environment, in particular, those controls common to the whole group. We'll want to think from a control perspective about whether the consolidation journals have been posted by someone with expertise. We'll want to make sure the group, instructions are very clear about who has responsibility for what. In the group accounts, think about goodwill, fair value of consideration. Contingent consideration must be measured at fair value. Deferred consideration must be discounted to present value. Again, equity consideration, you must use the share price, at the date of the purchase, not a later date. All of those things can be tested. They will be tested because AAA is testing your accounting knowledge from SBR. So extensive use of fair value for the consideration. Use of fair value possibly for the value of the NCI, and use of fair value for the net assets acquired. All those fair value adjustments, what you can recognise, what you can't recognise. And even when you get to a number at the end, remember, You then have an annual review for goodwill, for impairment of goodwill as a whole. So a lot of judgment going on there. Finally, in the group books, don't forget, some things are complex. Intercompany transactions, they never cancel out, do they? Well, they're supposed to, but you remember in FR, they never did because things went wrong. Unrealised profit, is it margin, is it markup? We get that wrong, don't we? And then we get the deferred tax aspects wrong because unrealised profit, is it deferred tax asset or liability? It's an asset, by the way. But if you've kind of got a muddle over that, the client will have a bigger muddle. In a sense, when I look at a group audit question, I'd almost start by thinking about that and saying, when I read this question, in respect of the group audit risks, these are the sorts of things I expect to see. Then when you come to read the scenario, they don't actually turn out to be as much of a surprise. As always, it's question practice that sorts things out. Finally, 2 bits of small technical knowledge but straightforward. The first one, joint audits. Well, this is an extraordinary situation where 2 firms, because of local regulation, are both appointed. They're both responsible for the audit opinion. I expect at some stage at school or college you were put in a group with someone, and occasionally you're put in a group for some group work with someone who you don't think is any good, and it's just awful, isn't it? It's the same here. So the 2 auditors know that they could both be sued, so they're continually looking over each other's shoulders. It'd be like 2 mountaineers going up a mountain, and you'd be saying, has that person tied the rope properly before I hold on to it? So that's a joint audit. The other one, transnational audit, is often misunderstood. It is not international. Everything is international. All audits are international because all companies at some stage trade with somewhere outside their home currency. It happens, doesn't it? A little bit. Transnational is a much narrower category. As it says here, it's an audit of financial statements where those accounts will be relied upon outside the home jurisdiction. Why? For the purpose of significant lending, investment or regulatory decisions. So, as an example, e.g., perhaps you've got a French company from France, and the French company goes for a listing in the USA. So they go for a listing on the American stock market. In that situation, again, it will be, the accounts are going to be looked at by the USA regulators, whoever they are. It becomes transnational. So it's not like just saying the French company buys a McDonald's one day. It's more significant. So that's when you get transnational audits, where you have to take additional account of the circumstances of what's happening and think perhaps about things like changes in regulation and so on. Let's summarise what we've said then with group audits. We talked about responsibility. The group auditor is responsible for everything. However, everyone must get involved in the audit. The component auditor is part of the engagement team for the group audit, and the group auditor must get involved in the audit of the components. Nice little ideas list if you're asked to assess a component auditor or anyone else. STRIP. Also, again, a little list there of audit risks which may help you again when you're facing a real question 1 that's got group accounts as part of it. There we are. That is group audits.